Registrations are now open for our ACCA Performance Management exam course. Get access to our comprehensive playlist of over 46 hours of content, including concept videos covering the entire syllabus, exam videos explaining how those concepts are tested in the exam, and question videos to help you with exam practice. Subscribe to one of our packages. The smallest package, for $10, you get access to the entire course for 7 days, or you can subscribe to one of our longer term packages. For more information, check out the links in the description below. And now, on to the video. Hello everyone, and how are you all doing today? So today we're going to be doing yet another past paper question for the ACCA Performance Management exam. And the question we're doing today is from the most recent paper, December 2019. And as you can see, compared to other past papers, the format is a bit different because for some reason they've taken the question directly from the computer-based exam system. Now, what that has done is it's made the text really small and difficult to read. So I hope you guys are able to read this in the video itself. Otherwise, maybe put a full screen, or even better yet, just go to the ACCA website, type ACCA F5 past papers, open up this paper, so that you can follow along as we do the question over here, okay? So this question, the reason I wanted to do this question, despite this formatting issue, is that it's a good question for budgets, which is a popular topic in the recent sittings of the exam. And this is particularly for flex budgets, but it also covers some other types of budgets as well from an analysis standpoint. So there's a calculation and there's analysis as well. Now, if you look at the requirements here, okay, you'll notice that since it's a computer-based exam, there's they've shown this word processing software over here, right? A small snippet of the word processing software, and now they've given a capability button for tables, etc. as well, which were not there in previous sittings prior to this. So they've been updating this software, right? So in some other videos I might have mentioned, when using Microsoft Word to answer a question, that they don't have tables, the table functionality, but now they do based on these screenshots. Okay, so that's good news. But that being said, even though they have word processing, a word processing sheet over here for this answer, and would have had the same in the exam, I'm still going to be using a spreadsheet. Why? Because there's calculations involved, and I didn't want to have a situation where I have to go back and forth on the screen between a calculator and the Word file, as it would get a bit messy and confusing and difficult for you guys to follow. So I'm keeping it in an Excel sheet just so that the calculation process is a bit smoother. But yeah, you could practice this on Word as well. I would recommend you do so if you do the question on your own. Okay, so I think that covers the introduction. Let's start with the question itself, and as always we were going to start with the requirements in any case, right? So the first requirement, part one, prepare a flexed budget for Cowley restaurant, right? And then in part 2 we have to, with reference to part 1, explain the weaknesses of the current budget statements. Okay, so let's start with the calculation, preparing a flexed budget for Cowley restaurant. Now, before going through the question itself, let's just structure what our answer is going to look like. Because whenever we have a flex budget, so this is going to be scenario 1, we'll put that in bold, and we're doing part A, part 1. Okay, so whenever we have a flex budget, like we covered in our videos, there's going to be 4 columns that we need. Okay, those are the original budget column, right? Those are the flexed budget column, the actual numbers, and the variances, right? This is the standard template you need to follow when preparing a flexed budget, right? And what was the flexed budget? Basically, we're adjusting the old budget numbers to make it to flex the budget and update it so that it's made according to the actual number of units we sold rather than the budgeted number of units we plan to sell. Okay, so let's see, let's just shift this column here. Let's see what we have in the question. Okay, Now they've given us the numbers down below as well, but let's just read through in case they mention any extra information relevant to our calculation. So it says Yumiko owns a number of restaurants. It is a well-established company and its restaurants have gained a favorable reputation. That's fine. Yumiko's restaurants are all set in rural locations where there is limited competition and enable them to develop a loyal customer base. Restaurants design their own menus and decor to fit with the requirements of their local market. So they're catering to each specific market, which might be relevant for the budget analysis. Yumiko has been consistently profitable. However, as is the case across the restaurant industry, profit margins are quite low, and there is still constant need for Yumiko to monitor costs. One of Yumiko's restaurants is located in the small town of Kauli. Kauli has recently been the location for filming a popular television series, and the visitor numbers to the town have increased significantly as a result, which is why I think we need to make the flex budget. Yumiko restaurant in Kauli has noticed a similar increase in customer numbers. Okay. At the start of the current month, a new restaurant opened in Kauli, so they have a competitor now, which would somewhat offset the additional customers. The manager of Yumiko's restaurant in Kauli has expressed concerns about the impact of the new competitor and their ability to achieve profit targets, right? Okay. Budgets for all Yumiko's restaurants are prepared by the head office. Okay, so they're prepared by the head office, not by the local manager. That's a point we could probably make when we analyze. Okay. At the start of each year, restaurant managers are given an annual budget, which is split into months. At the end of each month, they receive a statement showing their actual performance against the budget, and this is a statement for the most recent month. Okay, so we have the old budget numbers here in the second column, we have the actual numbers here, and they've shown the variances for that, which is fine, but we'll do our variance calculation based on the flexed budget numbers versus the actual. Notes: rent, rates, and other overheads are apportioned to its restaurants by Yumiko's head office based on a fixed annual charge. Okay, so those are basically head office costs, rent, rates, and other overheads. All other budgeted costs are treated as variable costs based on the expected number of customers. So after all of that reading, finally something relevant for the flex budget. Apart from rent, rates, and other overheads, so apart from this, all the other costs are variable costs. And why is this relevant? Because remember, when we flex a budget, revenue and variable costs change with the number of units. So we flex those numbers, but fixed costs will remain the same. Okay, so now we know what is fixed and what is variable. Yumiko currently adopts an incremental approach to budgets, with the annual budget figures for each year being based on the previous year figures. However, new finance director has joined the company and has questioned whether this is suitable for all of Yumiko's restaurants, and he suggested that the company should move to a participative or bottom-up approach basically to budgeting. Okay, so let's flex the budget. We know our variable costs and our fixed costs. So we have revenue, we have our costs, which include food and drink. Okay, we have wages, we have heat and power. Let's just give the shorthands, right? We have rent and overheads, and we have the profit. Okay, let's just stretch this out a bit. I hope we still have space. Let's just stretch this in so that we have everything on screen. So I hope you guys can see the variances column. Let's just bring these in a bit so that's easier to see. Okay, right, so original budget numbers. Oh, we'll need one more column. We'll need it for units, right? So let's show that up here, units. So the original budget had 1,500 units. We don't need this to be bold. The flex budget will have the actual number of units, which is 1,800, which will also be the number of units here. Okay. Now, revenue for original budget will take everything directly from the question. So 75,000. Costs are 22,500, 31,500, 7,500, and 12,000. Okay. And for the profit, we'll just add the numbers here. Why? Because we'll check the final number here with the number there to see if we typed in all the numbers correctly. We did, because they're both 1,500. And profits we can make bold as well. Okay. So we're clear on the original budget. After that, the flex budget. First, let's just put the actual numbers in as well. So this was 87,300, this was minus 26,100, this was minus 38,250, this was minus 8,100, and this was minus 12,600. Okay, so we'll once again add these up to check. 2250, 2250. Okay, and now we have our flex budget. So flex budget is based on the flex factor. Basically, we'll put the flex factor where we take the actual number of units, so 1800, over the budgeted number of units, right? So it's 1.2, and we multiply all the revenue and variable cost amounts by this. So we'll multiply this by this, we'll fix the formula, and then we'll just copy paste it until we reach the fixed cost. The fixed cost will remain identical to the original budget, so we end up with a profit of 4,200. Okay, so we have our flex budget numbers as well. Let's just change the format to make these accounting based numbers so that they're easier to read, right? So yeah, okay, now we can calculate the variances. Now students often ask for variances, is it flex budget minus actual or actual minus flex budget? Don't go by that, because if you mix that up, you'll get all your numbers wrong. Rather, for each situation, look at what the current apply the logic, and based on that find whether the variance is favorable or adverse. So for the first situation, revenue, we said that our revenue should have been 90,000. It ended up being 87,300. Is that good or bad? It's bad, because we made less revenue than was necessary. So we'll take the 87,300 minus the 90,000 to show an adverse variance, right? Because I don't have space for the next column on the screen to write adverse or favorable next to it, so we'll just use negative and positive numbers, and we'll mention that down below. Negative variances are adverse and positive variances are favorable. Okay, so rather than just memorizing that, oh, for revenue it's actual minus budget, no, just apply the logic, right? See conceptually what it is. That way you won't go wrong. If you mix up the formula, everything's going to be the exact opposite. Okay, now we're dealing with cost, so technically we'll know it's the opposite of actual minus budget. It's now budget minus actual. But again, just to apply the logic, we said our cost was going to be 27,000. It ended up being 26,100, right? That's a good thing, right? So that should be a favorable variance. So that's 900. Oops, have I mixed it up? Oh, right, because I put negative numbers there. See? So that's why we should apply things conceptually. So it's $900. Okay, favorable, because our actual cost was less than our budgeted cost. But now we can apply the same for all the costs, because they'll follow the same trend. So these were adverse because our actual cost was more than the budgeted cost. These were favorable. Once again, actual was less than budgeted, and these were adverse because actual was more than budgeted. Okay, and once again, we'll just add up the variances to take the total, which is 1950 adverse. So we had a bad variances. Okay, so that's part A. Part 1, they just said to calculate. I don't think they said anything else in the requirement. Yeah, prepare a flex budget for the restaurant. So for 3 marks, we're done. It took a bit of time, but calculations always take more than the expected amount of time. Part 2 for 4 marks. Okay, so what are they saying now? They're saying with reference to your answer from part 1. So we need to make reference to part 1. Okay, explain the main weaknesses in the current budget statements issued to the restaurants as the basis of managing performance, right? So we need to incorporate the calculation when doing our discussion, because there were certain issues up there that we saw in the case about the current monthly statements that we can already highlight. But now let's keep in mind, this is for 4 marks, so we don't need to go overboard. Let's make a few points, ideally at least 4 points, and then we move on, right? Okay. So first of all, we flex the budget, and as we saw from flexing the budget, there were some issues. Why is this the current budget situation an issue? Well, the current budget's approach is incremental budgeting based on the previous year figures, right? That's a problem because now the situation has changed. There's a new competitor, they have filmed a movie in that location, so the budget it assumes that everything is remaining the same, which could have been okay for the previous environment, but not the current environment. Furthermore, the budget is not flexed, right? Right now, it just takes things as is. It doesn't consider the number of units. So I think that's the first point we should highlight, that the budget is not flexed. The current budget is not, system does not use flexed budgeting, right? Okay, rather we should stick to this because incremental budgets, I'm sure, could be covered in the analysis further down below, because they want us to refer to part 1. Let's focus our points around that. Okay, so the current budget system does not use flex budgeting. This is problematic because, as we can see, the actual number of units sold was 20% higher based on 1.2 flex factor, right? 20% higher than the budgeted number of units. This would naturally increase sales and variable costs. So comparing the old budget to the actual numbers for these would be pointless, as we would have a favorable sales variance because it's you sold more units, and adverse variable cost variances, right? As we can see over here, the sales variance was favorable, the variable cost variances were adverse, because that's expected, right? As we can see in the variances of the budget in the question, this is the case. Okay, so one problem is that they don't flex it, so the old budget is not considering that sales and variable costs would naturally increase. Now let's talk about the numbers we did in calculation part A. How do they impact this calculation? Actually, the revenue was they underperformed given the fact they sold 1800 units. In other words, they didn't make the same revenue per customer that they would have, right? There's a number of customers. Why am I saying units, right? So they made less revenue per customer than expected, because if they had made the same revenue as they did originally, they should have made 90,000 in revenue. They instead made 87,300 in revenue. So we can mention that the flex budget highlights this fact. Due to this, the impression is that the sales performance is very good. However, once we flex the budget, we actually get an adverse variance for sales. This indicates that the revenue increase was simply from having more customers, but also provides insight that the average revenue per customer actually decreased, right? Okay. Likewise, for variable costs, some costs are now have favorable variances, some have adverse variances. Okay. Now, one could ask a question about the costs themselves. Whenever you have a flex budget, this is a standard point you can think about. Are all the costs categorized appropriately, right? So for example, rent rates and other overheads were fixed, but the rest of these things, food and drink, staff, and heat, light, and power, were variable. Should they all have been variable and fixed accordingly? Food and drink makes sense that they'll be variable based on the number of customers. Staff wages could be argued either way depending on how they pay their staff. If they pay them based on some production metric, then no, they shouldn't be variable, they should be fixed. I don't think they've mentioned anything for staff, but we can discuss that point potentially. And heat, light, and power well, you would argue that the restaurant lights will remain on regardless of the fact that if there's 1 customer or 10 customers. So these should likely be fixed. So let's see what the budget tells us about this, right? Because again, we're analyzing the flex budget. So food and drink increased 900 favorable. So the actual cost was slightly less than expected, but because the revenue was slightly less than expected per customer, that means that customers on average are ordering less. So that means you have less food and drink cost per customer as well. Okay. The flexed budget provides further insight by showing that less revenue per customer also meant less food and drink costs per customer, as shown by the favorable variance, right? The previous variance was adverse and was not giving any such insight, right? So we make that point accordingly, right? Now again, you would be tempted to make points about the other issues like incremental budgets, etc. But again, because if the fact that they stressed in the requirement that we need to do it based on the calculations of part A1, we will stick to that, right? We made quite a few points. I think let's just add maybe one more point and be done with it. So either let's talk about the wages or the heat and power. I think the heat and power is more relevant because that's more definitive, right? Wages you can argue are variable or fixed. There's an argument to be made, but heat and power should be considered fixed. I think that's pretty obvious. And if we look at heat and power, they had an adverse variance here, right? Because they exceeded the budget. But if we compare over here, because of the variable costs, assuming them to be variable costs, they actually had a favorable variance, okay? So we can argue that point on whether or not this highlights the fact that it might be problematic to consider them variable because they're showing that they're favorable even though there's more customers, right? The old budget treats heat and power costs as variable, right? And due to the adverse variance being shown along with the other types of variances, of other cost variances, there is no further thought put into this. But however, one can argue that heat and power variances should be considered fixed instead, as they tend to remain the same regardless of how many customers are in the restaurant, right? Okay, now technically we can wrap up the point here. It's for 4 marks. It shows it's favorable here that the actual cost was less than what it should have been based on the flex budget, indicating that it's not really following a variable trend, right? So let's just quickly make that point. This is apparent as the actual cost is less than the flexed budget cost, indicating that they are not following a truly variable cost behavior. Okay, and we'll stop there because that's 4 points, 4 marks. I think we don't need to spend too much time here. Let's move on, because again, keep your eye on the time, right? This is all for 4 marks. We don't need to stress too much over here. especially when there's 2 parts for 6 and 7 marks coming up. Okay, now it says part B, discuss whether an incremental approach to budgeting is appropriate for Yumiko, right? So now there's a separation. So we could have made all those points about incremental budget, but in the wrong requirement and lost marks. The good thing about computer-based exam is you could have simply cut and paste them for part B instead, but still, right? So let's do this now. Part B, incremental budget, and part C, it says define a participative approach to budget and explain the potential advantages, disadvantages for it. Okay, so we don't need to make any points about participative budget here or flex budget here. Like we did in the first part, we focused on the flex budget. Now in the second part, we're going to focus from the aspect of incremental budgeting approach. Okay, so let's start. We already made a few points when we were talking about in the previous part. So let's just read the requirement one more time carefully to indicate how we need to go about it. It says discuss whether an incremental approach to budgeting is appropriate for Yumiko. So we need to word our analysis in a way in which we're looking at the positive and negatives. Yes, it is appropriate for this reason, or no, it's not appropriate for this reason, right? So let's consider that. So let's start from the beginning when we talked about the points. They had a loyal customer base, right? And if you have a loyal customer base, that means your customer numbers are consistent. So you could argue that and they had limited competition and they were in a rural location. So because rural locations, things don't go to as fast as city or urban locations, you could argue that the environment was relatively stable, that incremental budget was suitable, at least initially, right? So the restaurants are based in rural locations where there is limited competition and a loyal customer base, right? All this suggests that the environment is relatively stable. This is very suitable for incremental budgets, right? Okay, so that's one point. Okay, after that, so we're looking for 6 ideally. Yumiko has been consistently profitable. However, the case in the restaurant industry, profit margins are quite low and there is still constant need to monitor costs. So the issue with incremental budgets is you just take last year's numbers and you tweak them and you have this year's budget and then you work with that. There is no focus like in other budgeting approaches on studying cost behavior, on trying to analyze costs and reduce them, right? Like in zero-based budget, you justify what goes into the budget, so you're analyzing costs and trying to reduce them. Or activity-based budget, again, you're looking at all the different costs and activities. So that's not being done here, so we can mention that. Yumiko needs to monitor costs and keep them low to maintain profit margins. However, incremental budgeting only rolls forward the previous year numbers and does not have an explicit focus on reducing costs like other methods such as zero-based budgeting, right? Okay, so that's our second point. Let's move on. So again, we'll go sentence by sentence, make a point, move on. If we can't find a point, leave it for the time being, move on, and then come back later, right? One of Yumiko's restaurants is located in a small town in Cowley. So are we talking about the restaurant for Cowley or Yumiko as a whole? Let's just clarify that. Discuss incremental approach for Yumiko. So we can talk from an overall standpoint, right? There's no harm in always going back to revisit the requirement to make sure you're on track, right? And in fact, I'd recommend it. So the Cowley has recently been the location of filming popular television series. Their numbers have increased significantly, and Yumiko has also experienced an increase in customer numbers. So that's changes in conditions. Okay, so we can modify the first point a bit. However, recently Yumiko has been experiencing increases in customers, right? Keeping in mind, let's just put a few more lines in mind, that incremental budgets focus heavily on the numbers for previous years. They might carry forward inefficiencies and not take into account the changes in the environment, right? Okay, so that's another point we can make about the suitability, or rather lack thereof. Okay, and that's the good thing about computer-based exams. You can always go back and add more points so that your points flow and are linked to each other. Okay. At the start of the current month, a new restaurant opened in Kaoli, so they have competition, and the manager of Yumiko has expressed concerns about how this will impact. Again, we can highlight this as well, right? So, furthermore, with a new competitor entering the market for the rest in Kaoli, the budgets would need to be modified to reflect the changes expected to revenue, costs, and profit margins. This is unlikely to be done using incremental budgets, where the prior numbers serve as the key benchmark. Okay, so yet another issue with incremental budget. So far, 1 good point, 3 bad points, right? Okay, budgets for all Yumiko's restaurants are prepared by the head office at the start of each year. Restaurant managers are given an annual budget split into months, etc. Okay, that's fine. Yumiko currently adopts the incremental approach to budget, with annual budget figures being based on previous year figures. However, a new finance manager has discussed whether this is suitable to all restaurants. Okay, so it's what other points can we make? There aren't any points here. Let's go back up. It owns a number of restaurants and it's a well-established company. Okay, so it's a well-established company as well. So let's just mention that point as well. Yumiko is a well-established company, right? That suggests that it caters to a stable environment, right? Okay, now we've made 4 points and we've gone into detail, so 1 to 2 marks per point were covered. Let's just quickly recap if there's any other thing we can mention. So incremental budgets, usually it's about the rolling forward of inefficiencies. It's about the fact that they rely a lot on previous year numbers. They're simple and easy to execute, right? We can make that point, right? Because incremental budgets take less time compared to other techniques like zero-based budgeting. And given the fact they want to keep their costs low, that's good, right? So we'll make that point, and then I think we'll move on to the next part. That being said, Yumiko wants to keep costs low, and incremental budgeting is one of the budgeting techniques which takes less time and effort, incurring less costs. Okay, so this would make it suitable for Yumiko. Okay, and we'll just make a small conclusion. Overall, while incremental budgeting has its advantages, given the changes in Yumiko's environment, it might not be as suitable as it once was. Okay, so we have our conclusion and we're done. Let's move on to part C. Again, the key is not to get bogged down. So potentially we could try to fish for more points as well, but we don't want to take too much time, right? Now, last one, define the participative approach to budgeting and explain the potential advantages and disadvantages of introducing the approach to Yumiko. So we need to highlight its advantages and disadvantages and link it back to the case. First, let's define it. Participative budgeting is an approach also known as bottom-up budgeting, also known as bottom-up budgeting. We're mentioning this so that we can use these terms interchangeably during our analysis. Is an approach where lower level management is also involved in the budgeting process. The top level management shares the overall plan and strategy and parameters with the lower level management, who then prepare budgets catering to their division / location based on those parameters. There is discussion and coordination with lower level management sharing their inputs and opinions before a final decision is made by the top level management. Okay, so we've given a thorough definition. We'll explain the process. Now let's talk about the advantages. We've already mentioned one in the definition, that they make budgets cater to the division and the location. One advantage is that the lower level management is able to cater the budget to their location. This is relevant for Yumiko as managers such as the one in Kohli can modify their local budget to cater to local circumstances. For example, like the new competitor. Okay, okay, apart from that, what other advantages or disadvantages does it have? Motivating staff. So this will be motivational. This will further motivate the managers to perform better, as they now have a say in the budget. This will also cause them to take ownership of the targets that they have been involved in setting. This will encourage improvements and efficiency, which can potentially lead to better cost management, which Yumiko hopes for, right? So we tied back all the points, we always tie back to the case. Okay, so it's more motivational, you're able to cater to the local environment. What else, right? Oh, since we're mentioning advantages, disadvantages, let's give headings so that it's easier for the examiner to follow as well. Advantages and disadvantages. So it's 7 marks, and we have the definition, which would be for 1-2 marks. Let's try to get at least 3 more points and then we'll wrap up. So one disadvantage would be that because the lower level management is involved, they might try to make their targets easier, right? One issue is that lower level management might try to make the budgeted targets easier to achieve, right? This would be problematic in situations where there is new competition and the company should be pushing harder rather than slacking, because that's the buzzword, budgetary slacking, right? Okay, what other disadvantage? We talked about time, right? But because management is more involved and lower level management is more involved and there's the back and forth negotiation, it'll take more time and potentially more cost. The involvement of lower level management also means that the budgeting process will take more time and therefore incur more cost, which goes against the needs of Yumiko to keep costs low in order to enhance the profit margins. Okay, what else? Let's see. Apart from that, participative budgeting, bottom-up budgeting, one of its other advantages is when you cater to each situation in the environment, you motivate staff. But furthermore, this lower level staff has a better idea, right? The main team does not know that Kohli they might know, but they won't know as well how much the impact of the television series was, and then a competitor is coming in, right? So they'll be more aware than the head office. The lower level management will be more aware of than the head office about the circumstances of each market and can respond to changes and updates accordingly. Okay, for example, so let's illustrate this as well, no need to be vague. For example, the manager at Kohli would know best about the impact of the new television series being filmed on location for his restaurant. Okay. So yeah, I think we've covered enough points. 3 advantages, 2 disadvantages, 5 marks there, and 1-2 marks for the definition. We've covered the 7 marks. Okay. So yeah, that's the question. We did some calculation, the flex budget calculation. Remember the format. We did the analysis. The main takeaways for the analysis is be careful about the requirements. So for the flex budget requirement, we needed to cater specifically to the flex budget calculation. Because there would always be a temptation that there were so many other points in the case, but we needed to wait for that for the subsequent requirements where we cater to those requirements specifically. So moral of the story, make sure to revisit the requirements over and over again to make sure your analysis is hitting those points as per the requirement. Okay, so I hope you guys benefited from this, and I'll see you guys next time.